Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guests are Allison Williams and Anna Ramos. Allison is the Senior Vice President and Chief Production Officer at Walker Dunlop, and Anna is a Managing Director for the West Coast and Mountain regions. And in just a minute, we're going to speak with Allison and Anna about commercial lending strategies for multifamily. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how attractive our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, we encourage you to subscribe. With that, I want to welcome my guest, Allison Williams and Anna Ramos. Welcome to CRE PN Radio.
Great. Thank you for having us.
Thank you.
Well, I'm really looking forward to our conversation today. Before we get started, if you guys could take a second and share with the listeners a little bit about your background.
Absolutely. I'll start. So as Darren mentioned, I'm Alison Williams. I'm Senior Vice President and Chief Production Officer at Walker Dunlop. I oversee the small balance lending department where we focus on smaller multifamily assets, usually loan sizes ranging from 1 to 15 million. I've got a team of seasoned professionals scattering coast to coast, and Anna Ramos is one of our best and talented individuals out in the West Coast and Mountain region. And I'll kick it over to Anna.
Thank you, Allison. Hi, and I am Anna Ramos. I'm a managing director here at Walker and Dunlop, and like we discussed, I oversee the Western and Mountain region. I have currently a team of 5, and we're here to definitely boost up the small loan production over the entire West.
Got it.
Yeah.
Well, I'm like I said, I'm excited to have our conversation there and get a chance to talk with you guys today. I guess the first question I'd have is Walker Dunlop. Are you guys a direct lender, or do you go through mortgage brokers, or not mortgage brokers, but commercial real estate brokers?
So I like to think of us as the best secret out there. So we actually are direct lenders. We were founded in 1937 and then went public in 2010. But we were actually one of the very first Fannie Mae approved just lenders that started back in 1988. So we are a direct lender for Freddie Mac and Fannie Mae, and we also have our own proprietary lending programs. So if there is a borrower out there that's looking for direct financing, or a broker that's actually looking to access a direct lender, then we are that group. Historically, we've been top number 1 with Fannie Mae 7 out of the last 10 years. And we are consistently a top 5 Freddie Mac lender and a top 3 HUD lender. So dominantly playing in the multifamily lending space. Just to kind of give you an idea of our scale and size, in 2021, our company, financed and sold over $68 billion in commercial real estate assets, and the primary focus has always been multifamily.
Got it. I was going to ask you if it was limited or focused strictly on the multifamily, or if you were across all asset classes. But
we are across all asset classes. So we do anything that's income cash flowing or construction that will be cash flowing assets. So retail, hospitality, industrial, office, self-storage, multifamily. But predominantly our team, when you look at the individuals in our origination, they are truly focused on the multifamily space.
Got it. And in that, I'm kind of curious, the way I was having a conversation with somebody the other day, and we got to the point of some of the pricing is getting, or it has been right till rates are starting to creep up. We'll see what happens, but the price per door was getting so costly that it looked like the construction option was looking more and more attractive. Are you finding that construction lending is there increased interest in that, or is that always been kind of the steady Eddie, or can you?
Yeah, I mean, I think construction lending has actually been probably, it's been more difficult actually, because in order to find vacant land, right, or repurposed land, that's extremely difficult in prime, locations. So I think that becomes more challenging as cities and other areas get built out. And then obviously with the rising cost of construction coupled with supply issues, we're actually seeing more people hit pause on construction than ever before. And I think that they find that they can actually go buy an existing asset below replacement cost, and then do some type of value add and immediately add value to that property. And they don't have to wait, 2 to 3 years to actually have it built.
Yeah, no, it's always made more sense to me is if you can buy it for less than it costs to build, that's a good option. I think Sam Zell, yeah, I love it. Sam Zell had that idea. That was good. So Fannie and Freddie, in a small balance, you said under 15 million, small balance is at the range kind of from 1 to 15. Is that where you guys define small balance?
Freddie Mac defines small loan up to 7.5, and Fannie Mae defines it up to 6 million.
Yeah, and then we have a proprietary program that goes up to 15. So
Okay.
what we find is that, most of our clients that play in, and I use the term loosely, smaller multifamily assets, typically are in, 1 to 20 million is kind of the asset valuation that they're targeting. So it was really important at Walker Dunlop for us to be able to serve, basically all of those areas. So that's why we ended up rolling out a newly launched proprietary platform that could take us up to 15 million to make sure that we're meeting the needs of the clients. Gotcha.
No, I was surprised, or not surprised, I guess, as you see the values continue to increase. What used to fit in the box doesn't fit in the box anymore. And if there's got to be some sort of adjustment to the market or to the platforms that are in play to make it still work. That's good. Well, so let's talk a little bit about the lender, the borrower lender relationship, and what you guys are looking for or to lend on.
Yeah, I would say, I'll take it, Allison. I would say on the small loan borrower, typically the requirements that we look for, minimum FICO score is 680 or better. The net worth, we'd like the net worth to equal the loan amount or greater. And liquidity, we do ask for 9 months of principal and interest payments of the existing loan that we're about to refinance. And we also are looking for some type of multifamily experience. 1 year to 2 years is something that we really need to get comfortable, depending whether it's Fannie or Freddie, to have at least that background of multifamily for the borrower to qualify. Typically, we like for them to be local, but if they're not local, we do ask for a third-party management if they're considered absentee, which is greater than 100 miles of the subject property.
Yeah, and one thing to point out, our requirements are obviously going to be a little bit different than maybe a bank, and that's because the lending that we do is all non-recourse. So, you are not actually signing any personal guarantees. Yeah. There's no contingent liabilities on somebody's balance sheet, which is extremely important, particularly if they decide to go and build another property, because that is something that lenders look at in terms of credit and financial strength. So everything that we're focused on is strictly based off of the property's performance. And then we supplement that with the borrower's experience, and obviously meeting, minimum net worth liquidity requirements.
And you know what? You just reminded me, Allie, one of the biggest things that I hear a lot of, and I did close a portfolio recently, the borrower refuses to provide tax returns. Most banks require tax returns. And on the agency side, we don't require that for qualifications. So we do ask for financials, real estate schedule, bank statements, but we don't require tax returns. And I think that's a big plus for a lot of borrowers.
Absolutely.
Yeah, no, there's a couple of things that you said there that I hadn't heard. I'd always heard, non-recourse was always like a preferred option if you could get it based on, if things blew up and there was some sort of something, unless you were committing fraud or something like that you weren't necessarily on the hook. But for you to frame it in as much as that it it improves your balance sheet to where if you're going to develop another property or something, I mean, it sounds like that's really probably the real benefit of having the non-recourse loan there.
Yeah, it's definitely. I mean, I think as people begin to scale and grow portfolios, they start to see, the value in doing just non-recourse loans. Not only from a liability standpoint, but also being able to give them access to more capital and to be able to actually scale quickly. Like as I mentioned, banks really are focusing on your contingent liabilities. What does your overall debt ratios look like? We don't get into that. We're really just underlying valuing the property itself. And making sure that we're comfortable with the cash flow that the property produces to meet our mortgage payments.
Yeah.
And what kind of a cover ratio do you guys require for the debt service cover ratio?
Typically, in larger markets, our minimum debt coverage ratio is 1.20. If not, across other markets, we're at 1.25.
And that's up to an 80% loan to value, so 20% down.
Yeah.
Okay. And what's a typical term? Do you guys do interest only, or is it pretty much principal
All
and
the
interest?
time. Yeah,
Okay.
I think that's a big thing that differentiates agency with banks, is that banks are really comfortable doing interest only. Agencies really comfortable doing interest only, full term interest only. That we have anything from a 5, 7, 10, 15, and we do have longer terms as well. So you believe it or not, some clients do want a 30-year term fully amortized. If they want to leave the property to their children, never want to touch it again, we do have a fully amortizing loan, which is great on the Fannie Mae side. We do sell that as well, but typically it's very popular with the non-recourse and cash out. I think that we see a lot of banks that some banks will definitely be aggressive in the pricing, but they limit the cash out. For us, I mean, we don't have an issue with cash out. If the property's performing, the property's maintained, we don't have an issue with cash out.
Yeah. And that's, something that we see a lot more common in the larger space than we do necessarily in the small, but I think it's something that the borrower should be aware of. I mean, what typically happens in the larger space is somebody acquires a property, they improve it, and then 3 to 5, maybe 7 years later, they either sell it or they actually then refinance it and pull new cash out, immediately right there. And that's treated as refinance proceeds. So it's taxed differently. And so that is just immediate, then they can pull proceeds out and then go buy their next asset. And that is really how you scale. So that's what we typically see our clients do. I wouldn't say that some want to hold long-term, obviously for generational wealth and for estate planning purposes. But I think those that we see scale quickly and pretty large, they're really improving the properties, creating value, and then coming back in for another bite at the apple. And that's what, I think is just a really, really strong business plan that has proven itself out year after year.
From experience, speed wins in that thing. The faster you can get it improved and get those higher rents and get that money back. That's really the way to do that. So that's good.
Yeah.
So let me ask on the cash out refi, same lending requirements or ratios. I mean, will you go to 80%
75.
again? Or
Typically on the cash out, we're at 75.
Okay. And then same on the debt cover or debt
Probably
service coverage?
125 to 130 for the cash out.
Okay. I say that was the, or I guess the balancing act, I guess it changed a little bit there when you go from the go in to go out. So talk about value add. Are you able to provide any of the funds for the capital improvements, or is that still required by the borrower to bring that?
In terms of programs, we do have some smaller bridge programs that we can apply and see if the property qualifies, and there's a structure and a plan in terms of what they're putting in place today. So between our proprietary and some of our bridge capital, we do have some of that starting at least $3 million in loan size and above that we can consider.
The agencies don't. So agencies are really looking for stabilized assets. We have seen where 1031 buyers will come in and they'll purchase something and then they actually want us to do a holdback for, capital improvements because it actually helps with their 1031 transaction. And so we'll do that and then we'll fund those dollars, as they're spent. But the program itself isn't structured to be like a true bridge program, as Anna was mentioning. those are more, debt funds. Some regional banks play in that space, and there's also just some investment firms that play in that space.
Got it. And when you do that kind of bridge thing, is it kind of like a construction loan then, where you have a line and you draw it down based on the
Yeah, I mean, it basically is an initial funding, so it's usually maybe 75% of total cost. So you would do 75% of purchase price, and you would do 100% hold back for any capital improvements. And then as those improvements are completed, then the borrower basically submits a draw to take those funds back. And it's all, tied to a set interest rate. But most of those deals are floating rate. Typically when you want to do, just as you mentioned, like a construction loan, right? So construction lending is always on a floating rate basis as well. And that's what we see in the bridge space. It's also typically, a 1 to 3 year term. It's not a long-term 5, 7, or 10-year program like we do with the agencies.
And then does that bridge then, do you convert that to permanent financing or is it?
You do, you refinance out
refinance.
though.
Okay,
Yep,
just
you
refinance, pay that off. Gotcha. All right, so kind of talked about the different types of loans. What do you project when you are talking with a borrower as far as closing fees? What kind of closing costs should one expect?
Yeah, no, typically, I mean, depending on the structure of the transaction, but typically closing fees will range anywhere between $3,500 to $7,000, just depending on the structure of the deal. Whether there's a different borrower structure, more like a TIC structure, or it's a little bit more convoluted versus straightforward, a single asset. So it'll depend, but anywhere between $35,000 to $7,000 at closing. We do collect an application fee that covers the third-party reports, which is the engineering and the appraisal. And then that's the actual closing fee that goes along with initially. Also, we do have closing fees of UCC searches and title and escrow that the borrower does take care of.
Got it. And for borrowers considering, or looking for financing for a multifamily property, what are some of the most important questions you think that a borrower should be asking their borrower or their lender?
For me personally, what I think the borrower, and the typical questions that I get is, one, how much cash out do you do? How much do you service? What's the servicing look like? What's the timing cost? And obviously the non-recourse. So what are my proceeds that you're able to do? IO is a big one, especially right now in today's environment, the cost and the timing. I think given where interest rates are, timing is really important. One of the advantages that we have is that, on the Freddie Mac side, we're able to lock the interest rate at application. So once the borrower signs the application, the interest rate is set, which is really critical and important in today's environment. On the Fannie Mae side, we can also accommodate an early rate lock, which takes about maybe 3 weeks. So it's not as quick, but it's also quick in order to accommodate that. So borrowers are always looking, how fast can you lock me? How fast can you close me? And what's it going to cost me? Primarily in the West Coast, what is it going to take to get it done? But IO is a big factor today, and that we're able to accommodate.
Yeah, and then Anna touched on servicing. So I think that's something that people don't really think about, but we do service all of our loans. That means we collect the mortgage payment, we hold the reserves, we're the group that's funding those reserves when you need them. So we kind of view ourselves more as a partner and an advisor in the entire lifespan of the deal, rather than just doing the origination and then tapping out. And so, some banks do service their own deals, but some actually outservice to another lender, or it might be sold post-closing. And that's just something that Walker Dunlop does not do.
Yeah.
Oh, that's great. That's my dad was a banker, and I didn't really understand what he did. I went to go borrow money, but that relationship is definitely it's critical to actually having the opportunity. I mean, when things do happen, to have somebody to contact and be able to work through, and that knows you or has a history.
Right.
Definitely important.
Yeah, I mean, I think the other thing too, you just made me think of something is, right now, obviously there's so much market uncertainty as well. And I think the other important piece is people are trying to decide which financial advisor they're going to use to, finance their next deal, is they need to think about how often are they in the market. and what is their access to capital. And while we are a dominant Freddie Mac and Fannie Mae lender, last year we closed with over 300 different capital sources. So I think making sure you pick the right partner that actually understands the landscape, and also sees how the markets move very quickly, and you've got to react fast, and you've got to have a lot of lending relationships to make sure you get the best structure and terms for your client. So just making sure that you pick the right partner, particularly in some times that we're in right now where it's a little bit uncertain.
I was going to ask you, you mentioned, or I think Anna had mentioned the questions that a borrower should ask. What kind of timeline should one expect to, from application to, presuming all of the information, comes in as you need it, but is there a realistic time frame that you see?
Yeah, it's very realistic to say 50 to 60 days. If we were going on the Fannie Mae side and it's an acquisition and we control more of the process just because of the model being a little more delegated to us, we can do something in 45 days. So just depending, but I would say average 60, but anything sooner than that we can accommodate on a case by case and how quickly the borrower does provide the information.
Got it. So Walker Dunlop, you guys are direct.
Mhm.
How would you compare a direct lender to a broker?
Well, that's easy. The broker, I think we have, that's a really good question because I do work with a lot of brokers myself. Given my previous history and where I came from, I do have a lot of relationships with brokers. But what I find here being at Walker is that although we are definitely a direct lender and our ratio is really high as direct business, we do have a lot of capital resources, a lot of capital available because we do work with life companies, banks, with other institutions that we're able to facilitate and help borrowers and direct them to the right structure and the right lending opportunity in order to get their loans done. So we are a direct lender, but we also have that capital resource. And like I said, I have experience and I do have a lot of clients that are brokers and we're able to work with them as well because we do work with brokers and we're able to structure deals and maintain that relationship as well.
Yeah, I mean, I think the other biggest difference is obviously when we're the direct lender, it's our credit team, it's our underwriting team that's actually underwriting the deal and approving it. And when you're a broker, you're basically relying, you're the intermediary. So you're relying on your communication with a group like us that then's communicating with credit. So, you're just one step removed. And like Anna said, we value our broker relationships. They're very important to us.
Yeah.
We honor them, we pay referral fees, et cetera, because we love that business. But, we predominantly are a direct lender. We have a lot of direct relationships because they know that the individual they're talking with ultimately is a part of the group that's making the ultimate decision.
Got it. And as far as like a borrower that's in the market for a property, we talked about from application to close. Any recommendations for establishing a relationship with you guys or Walker Dunlop before they're ready to make an application? Is there a good rule of thumb as far as getting in touch with you guys before that?
I would say yes. Today, actually, we do see a lot of referral business, a lot of from our quote app right now that we're marketing, and it's on our website. So even if today, what's great about the regional model and what we have today at Walker and Dunlop is that even if a borrower does not qualify today, we maintain contact with them. We continue the marketing. And we're also giving them guidance of if you don't qualify today or the deal doesn't fit the box today, here's what needs to happen in order to fit the model or to fit the box. And also for the borrower, what we do see a lot of is maybe lack of multifamily experience. So we encourage them to go and get a bank loan, a credit union loan, get that first, spend about a year or two, then come back to us. So we stay in contact with them in order to help them get ready for agency takeout.
Yeah, but you can't start that process too soon.
Yeah.
I think a lot of times borrowers come to us when they've already signed a contract and they've already said, we're going to close in 45 days, or, they based it on a loan that they just thought it was going to be 25% down because that's how they financed their last, home loan or second vacation property. And it's just a very different dynamic in the non-recourse lending. And so I always tell all of our clients, come to us early, let's have discussions, let us know what you're bidding on, what markets you're in. Depending on what market you're in, it could change how competitive a lender might be. So, we don't get paid until the deal closes. We're a free consultant on the front end. Reach out, talk to us. We'll guide you in terms of what we're seeing in the market, what to expect, how to underwrite the deal. And then, as Anna mentioned, and I'll share it with you here later, but we do have an online quote app that actually allows borrowers to put in property-specific information, including net operating income. And then it actually will tell the borrower what kind of loan they can get with very specific loan amounts and interest rates based on those assumptions. So that tool is there at all times if they didn't want to talk to somebody, but if they actually want to reach out and have communication with one of our bankers, we can make that introduction as well.
It's nice to have the tool. I find though that if you're really going to be serious, you got to have that conversation with, the person that's going to give you the thumbs up or thumbs down kind of thing. So, but nice to have the tool. I mean, I would think that, to give you some sort of a budget process or, some sort of idea. Do you ever engage or provide like a pre-approval letter that somebody can, depending on the market, I've seen, that can be something that tips the seller to consider you as opposed to, the other guy that's offering more that hasn't been approved kind of thing.
Yeah. What we see, so obviously the financing's contingent on the property's performance.
Right.
So if we're going to put out a soft quote, and actually provide that debt grid, it's all based on the property that they're actually acquiring. And we've already received financials, a trailing 12 income and expense statement and a rent roll. And just with those two pieces of information, we can tell you exactly where we think the loan would shake out. And we're happy to provide that, in a form that can be shared with a potential seller. But it's not per se like a pre-approval that you would see in the single family world where you're just approved for whatever loan amount based on your, personal assets and income.
Right. No, the commercial is obviously going to be tied to the property, but just I've just seen that give the edge to the one that has a relationship already with a banker as opposed to the one that hasn't.
Absolutely.
So that's good. So let's talk about current market. Today is we are recording this on May 18th, 22. Rates. What's your crystal ball, or what are your expectations with rates throughout the balance of 22?
So I would say I feel like we're in a much better place today than we were 30 or 60 days ago. 30 to 60 days ago, we saw a lot more movement in the treasury indexes, which is how we base our loan amounts. We base it over the 5, 7, or 10-year treasury yield. And we've started to see some normalcy in those. So we're hovering, the 10-year treasury is hovering around 3%. It's pretty much been, plus or minus 10 basis points of that for the last 30 days. But prior to that, it jumped 100 basis points from December, to today. So we had a lot of uncertainty and a lot of, just feelings of, concern, obviously in the beginning of the year. But I think we're finally at a point where, we can size appropriately. We don't feel like our loan proceeds are going to change dramatically. We're finding more borrowers are coming back in that were, kind of putting their deals on pause and sitting on the sidelines. I think for them, it's just managing expectations. If they can manage their expectation, they want to be in the market. But when you see market movements as wide as swings as we were seeing in March, it's really hard to do. So I feel much better today about where we are than I do 60 days ago. I think short-term interest rates, so SOFR, LIBOR, prime, obviously is going to continue to increase, and that's just based on where inflation is and what the Fed's going to have to do in order to combat that. But I think in terms of longer-term interest rates, I think we're in a pretty good spot. We'll probably see a little bit of uptick, but I don't know how great that will be. But we're starting to see a little bit of settling in that area.
Got it. Any sense of just the multifamily marketplace, looking forward to the next 12 months?
mean, last year was huge. So just in small multifamily alone, the asset valuations went up 15% year over year. And then debt originations went up 47%. So in 2021, it was $85 billion of financing for small multifamily assets in the US, which is just insane. The entire multifamily market was 470 billion. So you can just see, how big of a piece of a pie the small multifamily market is. And I think the forecast going forward, we haven't really seen that much of a slowdown. As I mentioned, there was a couple people, of our clients that were kind of on pause for 30 to 60 days, but it seems pretty normal again. So I think as long as we can continue to see rent increases, but that has to be justified by wage growth. And so in my mind, I go back to wage growth. What markets are we seeing wage growth in? Where are we seeing corporate relocations? If we can kind of track those areas, I think we're going to see a lot of activity, just kind of following those pockets.
Jobs.
Jobs. Absolutely. Yeah. And wages.
Yeah, exactly. Got to cover the wages. Job that doesn't pay enough isn't good enough. So,
yeah, absolutely.
So got it. Hey guys, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker and I try and work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, then we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, then we look to see if we can transfer the risk. And that's what an insurance policy is. And as such, I like to ask my guests if they can look at their own situation. Could be your clients, investors, tenants, the market, interest rates, political, however you choose to frame the question. But if you can take a look at your situation and identify what you consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Allison Williams and Anna Ramos, what is the biggest risk?
Anna, do you want to start?
Yeah. It's interesting because I don't think there's a lot of risk in what we do. And I think I'm pretty aggressive. I think we underwrite our loans pretty well. We're at a 125, 120 debt cover over break even. Yes, we are at a non-recourse loan, but we vetted out the client. So when I assess risk, I'm looking at risk. It's more for the borrower, the risk of capturing the rate in today's environment. The way we underwrite, the way we get our values, the way we package the file, I think the agency, when you look at agency historically, our losses are very minor. So if being as in on the origination side, I would love to be much more aggressive and see more risk, but we don't see that a lot. So it's really hard to speak on that, at least for me, because we don't see a lot of that. The losses they're unheard of. And it's very, very small just because of the way everything is packaged and the way everything is, the way we underwrite the transaction, the property, the sponsor, the management, and we service the loans and how often we service and how involved we are with the loan. So from beginning to end and also through the life of the loan. So for me, it would be more the borrower side that today, I think it's really critical, and especially in today's environment, is to lock that interest rate because of the risk and the volatility.
I'd echo Anna's comments, but I'll take a slightly different take. Yeah. And I think what concerns me the most when I think about today is affordable housing. There's just a massive demand for affordability right now. And every market with the amount of rent growth that we've seen in every city. I'm currently in Tampa. We had 25% rent growth year over year. And we're just starting to see, a lack of affordability, and with a lack of vacant land and where you can build and rising, construction costs and rising interest rate, it's going to become much more challenging to build affordable housing to fit the needs of, the average American. So I think that to me is when I think about the future and my daughter and that kind of stuff, I just think about like, wow, we've got to tackle this affordable housing crisis that we're dealing with right now.
Yeah, no, the affordable housing, it's kind of a Rubik's Cube kind of thing. Everything keeps going up and I don't know that we've got that figured out just yet, but definitely an ongoing problem. Does not look like it's going to be solved here soon. So good. Um, hey, Allison and Anna, where can the listeners go if they'd like to learn more or connect with you?
Perfect. Yeah, you can go to www.walkerdunlop.com, and then you can toggle over to small balance loans from there. And we actually have a very in-depth website that has blog posts on how-to financing guides. It has an entire regional map where our entire team, you can get bios and their location. You can also access our quote app where you can do live sizing of a deal and also see lender term sheets.
Awesome. Well, Allison and Anna, I can't say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and I look forward to doing it again soon.
I appreciate it. Thank you so much.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.